welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, PPF, NPS and ELSS, or the tax-saving mutual funds as they're popularly known, all of them are meant for long-term. They're long-term investment avenues. And all of them, they serve the same purpose. They help us save our taxes. So how is one different from the other? And where should you invest for maximum benefit? Which is the one that is best suited to your needs? We'll tell you all about it in today's episode. Stay tuned.
First, let's talk about Public Provident Fund. Well, Public Provident Fund is a pure fixed income based investment and is backed by the Government of India. It has a sovereign guarantee. Herein, you can regularly mobilize small amount of money, say every year or every month, to accumulate a larger corpus over the period of 15 years. It has a tenure of 15 years. While the interest on PPF is guaranteed and currently fetches you 7.1% per annum, the rate of interest is revised every quarter by the Government of India. However, the interest that you earn on PPF is completely tax-free. While the tenure of PPF is 15 years, it does allow premature closure and partial withdrawals, but there are a lot of strings attached to it. They can be made only in certain specified situations. Now let's talk about tax-saving mutual funds or equity-linked savings schemes, ELSS as they are formerly named. These are pure equity mutual funds wherein the fund manager has the flexibility to invest across companies of different sizes and sectors. The investment mandate is quite similar to a flexi-cap fund, but the added advantage is that investment in tax-saving funds is eligible for a deduction under Section 80C of the Income Tax Act. It comes with a lock-in period of 3 years. While the lock-in period is just 3 years, it is usually recommended that you stay invested at least for 5 to 7 years. The money invested in ELSS can be linked to any of your long-term goal, which is at least 5 to 7 years away, whether it be education of your child, your retirement, or any other long-term goal. Gains on mutual funds are taxed only when you realize them, that is at the time of redemption. And in case of tax-saving funds, the gains beyond rupees 1 lakh in a financial year are taxed at 10%. Next comes the NPS or the National Pension Scheme. It's a government-backed scheme and a defined pension contribution system. Here, your money is invested in a mix of equity and fixed income. The investor gets to choose the asset allocation or the proportion in which he wants to invest between equity and fixed income. The money is further managed by a pension fund manager of your choice. The minimum annual contribution required for it is just rupees 1,000. The money invested in NPS can virtually be used just for your retirement. You cannot withdraw the money invested in NPS before the age of 60, though there are certain situations wherein you can make partial withdrawals or request for a premature closure. There are several strings attached to it. Once you attain the age of 60, 60% of the accumulated corpus can be withdrawn as a tax-free lump sum, and with the remaining 40%, one needs to mandatorily buy an annuity plan. However, if the total corpus does not exceed rupees 5 lakh, you don't have to necessarily buy an annuity plan and the whole amount can be withdrawn as a lump sum. One of the biggest advantages of investing in NPS is that it's a very low cost investment. The expense ratio charged by the pension fund manager is very low as compared to ELSS. So you get a professional fund management as we get in case of tax saving funds, but here the expenses are very low. Before we go on to comparing the performance of ELSS, PPF and NPS, it is first important to understand the difference between equity and fixed income. Equities are riskier and volatile, and as we say, with risk comes the return. So they generate higher returns over the long term. On the contrary, fixed income provides stability to your portfolio. They are less risky, less volatile, and provide less returns. PPF is a pure fixed income investment and thereby is bound to generate lower returns as compared to tax-saving mutual funds, which are pure equity funds. At the same time, with NPS, the returns would depend on how much portion of the portfolio have you allocated to equities and how much have you allocated to fixed income. Even in equities, the structure of NPS is such that it invests dominantly in large cap stocks, whereas tax-saving mutual funds also allocate some portion to mid and small cap stocks. Because of the same, the returns of tax-saving funds can be slightly higher than NPS over long term. Now let us look at the accompanying graph where we have compared the worth of investment today had someone invested rupees 1 lakh at the end of every financial year over the last 10 years. So if someone would have invested just in Public Provident Fund, the worth of his investment would have been around 14.45 lakh rupees as of today. In case of NPS, it would have been 19.12 lakh. While calculating for NPS, we have assumed a 75-25 asset allocation, wherein 75% was invested in equities and 12.5% was invested each in corporate bonds and government bonds. And in case of ELSS, it would have been 20.83 lakh. While investing in NPS, the investor gets two investment options. One is the auto choice and the other is the active investment choice. In auto choice, allocation between equity and fixed income is decided automatically basis the age, whereas in active choice, the investor gets the option to choose how much to invest in equity and how much to invest in fixed income. However, if you choose the auto choice, the investor cannot invest more than 75% in equities after the age of 35. But if you choose the active investment choice, the investor can allocate up to 75% in equities till the age of 50. Being a long-term investment aimed at your retirement, it is recommended that you allocate as much possible to equities, and that can be done by choosing the active investment option while investing in NPS. The another advantage or the way how you can derive benefit from NPS is by claiming an additional tax benefit. Yes, besides the 1.5 lakh deduction limit available under the section 80C, investment in NPS are allowed for an additional deduction of up to rupees 50,000 in section 80 CCD 1B. Another advantage of NPS is that the investor can change the asset allocation between equity and fixed income without incurring any additional charges or tax liability. We have always emphasized on the fact that equities generate much better returns when you have a long investment horizon. So if you're someone who is just starting your career or have a long horizon for your retirement, or the aim of your investment is retirement, then PPF is probably not the suitable avenue. It has a long tenure of 15 years and yet invests in fixed income. In such a scenario, you must invest in tax saving funds or NPS. However, if you're someone who is nearing the age of 40 or are a conservative investor and wants to maintain an asset allocation wherein 70% goes to equity and 30% into fixed income, you can choose PPF for that purpose. Whether to choose between NPS or ELSS for your equity investments depends on what kind of an investor you are. Are you disciplined enough when it comes to invest for your own retirement? Or are you an investor who tends to dip in their retirement savings every now and then when the need arises? Well, if you're disciplined enough, then it is better to invest in tax saving funds or the ELSS because they have the shortest lock-in period of 3 years and invest completely in equities. Whereas in NPS, your investments gets locked till the age of 60. However, if you're not disciplined enough as an investor, then this lock-in period works as an advantage because it will ensure that you end up saving some money for your retirement. It won't allow you to withdraw or redeem your investments before the age of 60.
Well, I'm sure that must have given you some clarity. With that, it's a wrap on this episode. Keep watching this space for more information, and if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.